Swayam Prabha. Digital India. Educated India.
Namaskar. In session 27, we will be discussing about international financial integration. Here you have to understand that what is the meaning of international financial integration, how over the year the liberalization in domestic financial market including the foreign exchange market has helped the economy in integrating it with the world's financial system. What are the benefits of financial integration? What are the difficult part of the financial integration? And also we will be discussing about the features of financial integration, the variables or the parameters upon which the financial integration depends, and also we will discuss how the Indian financial system over the year has integrated or about to integrate with the world financial system. That is, what is the extent of integration of Indian financial market with the world financial system. So, what is the meaning of the financial integration? When I mention financial integration, we should understand that the financial integration means integration of various parts and subparts of in the financial system. In economy like India, we have different financial markets. The different markets are like money market, capital market and foreign exchange market. Within the money market, we have commercial paper, call money market, commercial papers market, certificate deposit market, and also we have government debt market, that is the short term government debt market, that is treasury bill market. Similarly, when I mention about capital market, we have long term debt market, which is nothing but corporate debt market and also government debt market. Similarly, we have equity market like the NSE and BSE equity market, all equities are being traded in different stock exchanges. When I mention foreign exchange market, we have foreign exchange spot market, foreign exchange forward market and also we have foreign exchange futures market. These are the different segments of market and their subparts are there. How within the money market, how different segments are integrated, and across the market, how money market linked to capital market, how capital market linked to forex market and the vice versa over the in the all three market, how they are integrated with among each other. And when I mention international integration, how the domestic financial market, that is the money market, capital market and foreign exchange market of India integrated with the world financial system, that is the that is called international integration of financial system. You have to understand the segment type of integration. At the same time, we have to understand that how the entire market, the financial system is integrated with the another financial system or the world level financial system, what is called international integration. So, the integration is a process by which segmented markets become open and unified, so that participants enjoy same unimpeded access, that is different parts and subparts of the financial market are integrated and the investor from one market to another market, they migrate themselves so as to enjoy the integration process, so as to get the benefit of financial product and financial arbitrage. How the financial market will be integrated? The financial market integration process will start once the economy remove the domestic and international controls on trade in asset, goods and services. By removing the barriers of trade, barriers of financial flow, then only integration will possible, possibilities are there. Financial integration leads to a rapid flow of funds from less return market to high return market, and in this process it brings equality in returns. That is, when the market, one market provides higher return, the financial flow will be there to that particular market, because there is no barriers in moving assets or investors from one market to another market. So, financial integration leads to rapid flow of funds from one market to another market to us to get the arbitrage opportunity, and when the market become integrated, the arbitrage opportunity will be almost 0. Return differential across the market could cause arbitrage opportunity, and arbitrage opportunity leads to flow of funds, and once flow of funds takes place, there will be arbitrage opportunity will be 0, and the law of one price will prevail in the integrated financial system. When law of one price prevails, then financial market is integrated. To understand there, in the integrated financial market, arbitrage opportunity is almost nil. In a segmented market, arbitrage opportunity is very high. However, in a segmented market, the arbitrage opportunities prevail because investors and product cannot, or the fund cannot migrate from one market to another market in a segmented market, because of the barriers are there which prevent them to migrate. So, in a segmented market, arbitrage opportunities are there, in a integrated market, arbitrage opportunities are not there. So, when I mention the financial integration on the basis of arbitrage opportunity, we have to understand that there are 3 traceable area of growth of financial market over the year. The basic requirements of financial integration is removal of barriers, or what is called removals of different kind of artificial barrier in which prevent in the movements of capital. The removal is nothing but reforming the financial market. Over the year, there are 3 traceable aspects of growth of financial market all over the world. That is what is called significant expansion and deepening of the existing market. Markets are significantly expanding and deepening, that is going for more innovation in product. Emergence of new financial market, the emergence of derivative market, insurance market, different kind of what is called risk management system procedure, commodity market, the new markets evolving over the year. And what is second aspect more important is that development of secondary market for many instruments. Earlier secondary market were not there, now secondary markets are there, and over the counter market are not happening, exchange traded funds are there, exchange traded instruments are there, and many instruments are designed for developing the secondary market for liquidity purpose, for buying and selling, for creation of liquidity and creation of what is called risk management practices. So, funds are being used in such market where there is more liquidity, where there is risk is less, and where there is possibilities of getting more return. So, there are emergence of new financial system, new financial market, and also there are emergence of what is called secondary market for new instrument, or also many other instruments which are earlier present. The financial market around the world at present are rapidly integrating into a single global marketplace, and developing countries are increasingly becoming a part to this process. So, financial market all over the world are rapidly integrating, and developing countries they realize that they cannot have a opaque financial system. They have to integrate with the world financial system, so that world financial system only provide them cheap fund and also help in their growth of their financial system and real sector of their economy. The process of co-integration is being driven by advances in communication technology, deregulation of financial market, and the increasing importance of institutional investors who are able and willing to invest internationally. The financial market all over the world converting into a global marketplace, and the prime investor in global marketplace are the institutional investor or the FII, foreign institutional investor, and they are inclined to invest and they are able to invest in international market. The migration of FII from one market to another market, by investing their in surplus investment, they are integrating the domestic market of all over the world into a global marketplace, where the investors are able to get the benefit of the global market return, and it is the development of technology, communication technology, and helping the world market to become a global marketplace. And financial integration some extent is possible only because removal of constraints of movement of capital, at the same time development of financial communication technology over the years. And if you understand, if you see the financial liberalization over the year, the progress of technical, institutional and financial innovation, and the recycling of OPEC surplus, the oil exporting country, they have surplus money, they are recycling their OPEC surplus in developing country and bringing them to the world marketplace. The integration of capital market is more pronounced nowadays because of FIs are investing in equity markets, and the liberalization and deregulation of domestic economy, particularly the developing country economy, are also providing opportunity for investor to invest in developing country equity market. Several Latin American country, Asian country have invested or implemented what is called financial sector reform measure, either forcefully or they understand that it is necessary for their economy, and they try to integrate with the world financial system by reforming their domestic capital market and domestic money market. There has been reform in global domestic economy, particularly developing country economy, by deregulating their interest rate, by allowing the credit and exchange rate as per the market determination process. They also enhance the integration with the world financial system, reforming their foreign exchange market. Countries like Korea, Malaysia, China, Argentina, Uruguay, Japan, Hong Kong, including India, are the some example where they have undertaken very recently reform measure so as to integrate their domestic economy, domestic financial system with the world financial system. If these are the financial reform for the different countries have undertaken to integrate their economy into the world financial system. In the Indian context, if you understand financial liberalization in Indian context, India in 1990s they realized that the country is at the brink of a collapse because of a control exchange rate regime, control financial system, and now time has come for India to liberalize the economy, and the Narasimhan committee recommendation were implemented to reform the financial sector of the economy, and in 1991 government of India liberalized the financial market, liberalized the banking sector, liberalized the money market, capital market, and for more efficiency, more productivity and more integration purpose. The deregulation of interest rate and market based allocation of resources have infused competition in financial system of India. The opening of current account, the partial liberalization of capital account has increased capital flow to the country. Similarly, the deregulation of interest rate and convergence of interest rate among short term market, that is the money market, credit market, gilt market, has led to integration of this market. The co-movement of various interest rate in uniform direction is an encouraging sign for the growing maturity of financial market in India. The process of financial integration has led to high volatility in stock market and also in foreign exchange market. These are the some opportunity and challenges which financial integration has thrown upon us to understand and mitigate the risks. So, integration has provided some kind of opportunity, at the same time some kind of challenges to domestic economy. Domestic policymakers have to observe this, have to abide by the integration process, at the same time devise the policy measure to observe the risks of the financial sector integration. So, Indian context, the deregulation of financial market, deregulation of interest rate, deregulation of foreign exchange market, and development of secondary market for many instruments, and had developed the financial sector integration process, and the process has been continuing since 91-92, and it has been carried out through the significant policy changes over the year. The policy changes are in the form of financial sector deregulation, banking sector reform measure, and development of money market, capital market, and equity market. Similarly, if you understand the financial sector reform measure in India in the form of reforming money market and gilt market, earlier there was no secondary market for call money, secondary market for gilt traded funds. So, now it has been developed. Deregulation of interest rate, deregulation of interest rate, particularly the banking sector interest rate has been deregulated. So, very short term interest rates are developed in India. These short term interest rates lead to integrate co-movement of the different short term financial product, and it help in integrating the short term money market and short term foreign exchange market in India. There has been significant reduction of CRR, SLR, which allowed the banks to invest in a more productive way. Similarly, current account has been liberalized and capital account has been significantly reformed over the years. Similarly, inflow outflow of NRI has been deregulated. FI are allowed to invest significantly in Indian stock market, Indian bond market. JDR other kind of domestic in the other kind of issued in the global market are being allowed for the domestic company, and the external commercial borrowing has been liberalized significantly, and these are the measure which provides some degree of integration and maturity to Indian financial system. Now, time has come to understand whether the integration is there or not, whether the integration is in the process of development or not. To understand this, we have to identify different parameters of integration, and or we can mention that some observable data which provides of some kind of information whether financial sector integration is taking place in India or not. To understand that, you have to first identify which are the indicators of integration. If you see financial some kind of literature that provides some kind of definition for integration, and the definition provide some kind of indicator for integration. Generally, we mention that openness is neither directly observable nor strictly defined, because nobody is defined what is openness. Openness, in other words, there should not be a opaque financial system. Opaque and openness to extreme position, but in between many other things, many possibilities are there. So, openness is neither directly observable nor strictly defined. Similarly, openness of an economy relates to cross border movement of goods, services, factor of production, particularly capital and labor. When tariff reduce over the year, tariff or the custom duty reduce, there may be movements of goods and services. when you reduce the barriers for movement of productive resources in the form of capital and labor, there may be also some degree of openness will be there. So, simplest measure of what is called openness or the integration is the trade flow, such as the flow of goods and services, import and export as a percentage to GDP. Generally, we mention that a country is relatively open if the trade as a percentage GDP is more than 15%. As regards to indicator openness, cross border capital flow, law of one price, identical assets should be priced similarly, the price differential, interest rate differential, return differential, these are the basic measure for basic measure or indicators of integration. Besides this, saving investment correlation, cross country consumption linkages, deviation of portfolio returns across the globe, these are the some kind of other measure which can be used for assessing the financial sector integration. To using this measure, whether it is possible for us to understand the extent of integration in Indian context also. So, what we have discussed, the indicators of integration, the trade GDP ratio above 15%, the movement of stock prices, the convergence of real interest rate, reduction of effective tariff rates, high correlation of short term interest rates, the correlation between overnight interest rate and foreign exchange forward premium, correlation between forward premium and call money rate, correlation between domestic saving and investment. These are the some indirectly measures of integration or indicators of integration. When I mention trade GDP ratio, we have to understand that trade is your export import. When I mention about co-movement of stock prices, you have to understand the return of National Stock Exchange in India, that is NSE, returns of NYSE or NASDAQ in USA. When I mention the convergence of real interest rate, you have to understand the short term interest rate, that is call money rate in India and Fed fund rate in US. When I mention the high correlation short term interest rate, you have to understand that in India short term interest rate should, the call money rate should move along with the Fed fund rate of US. Similarly, when I mention about overnight interest rate and forward premium, for foreign exchange forward premium, you understand that the interest differential in India and abroad should reflect the forward premium. So, that there may not be any kind of arbitrage opportunity available in the converting domestic currency to abroad currency and abroad currency in domestic currency. When there is no arbitrage opportunity, there will be market integration. So, similarly, correlation between forward premium call money rate. Since call money rate is a significant, call money rate is the short term interest rate, very short term interest rate, the forward premium should move along with the call money rate, that so that there will be integration of financial market. Correlation domestic saving and investment, because when the correlation is high between domestic saving and domestic investment, that means the country is not dependent upon foreign investment and foreign resources, the country is what is called the opaque in nature. When foreign investment provides some degree of saving to the domestic economy, domestic investment, there will be integration in financial system. So, these are the some kind of indicators of integration, and using this indicator we have to understand the extent of integration in Indian financial market. If you see the FI, foreign institutional investment, foreign direct investment, trade GDP ratio in Indian context, I try to find the all these things in two different phases. In India, we have liberalized their economy in 92-93, and till 92-93, till from 92-93 to 2002, 10 years of integration, and 2003 to 2012, another 10 years of integration. So, Indian economy since 93 has passed through 20 years. The 20 years of integration, 20 years of development has provided some degree of integration to the Indian financial system. So, I had defined it two different phases, 10 years each, and try to understand the the movement of integration or the process of integration or the extent of integration in two different phases of the financial sector reform. If you see the first 10 years of reform, that is 93 March to 2002 March, the FI, the FDI and trade GDP ratio. The trade GDP ratio, if you see, had increased significantly from 15.11 in 93 March to 19.34. There may be jump of 4 percentage over the 10 years. Similarly, FI and FDI had increased significantly in US dollar million, I have mentioned here. So, when 93 India got the investment of foreign direct investment 315 million, it increased to 6,130 million. Similarly, FDI investment is 315 million to 6,130 million, significant jump in FDI. Similarly, FI investment and the portfolio investment in bond and equity market, this also significantly increased over the year. There may be some fluctuation because of some inherent problem in domestic economy and during that phase. However, world recessions were there during this phase also. However, there has been significant increase since 92, 93 to 2001-2. Trade GDP ratio increased significantly during the 10 years. However, if you compare this first 10 years to the next 10 years, start from 2003 to 2012. So, this 10 years that has been significant, very large differences, these two phases of reform. The first phase, it was the what is called reform process. Then second phase is the result or fruits of this reform. The fruits of this reform or consolidation of this reform measures. The consolidation phase has given rise to significant jump in FI investment, FDI investment and also significant increase in trade GDP ratio. The first you let us understand the trade GDP ratio. Trade GDP ratio increased almost double from 21.83 to 42.97. The almost nearly 50% of our GDP trade is in the as a percentage of GDP. So, trade is export import both together. So, 50% of our trade is in the as a percentage of GDP, a significant measures, significant increase. Similarly, FDI investment merely 5,035 million to increase to 46,553 million. So, significant jump in FDI investment in India. The FI investment also fluctuating, however, significant jump is there, nearly 17,410 million, 10 million of US dollar invested in 2012 March, up to 2012 March. These are a significant jump in FI investment over the year. So, the two period, the period of reform and period of consolidation, 10 years each I have put, there is a significant change in the trade GDP ratio, FI investment and FDI investment, which indicate Indian economy is on the process of financial sector reform, or maybe in the I can mention here Indian economy is progressing, has been progressing towards more integration way and has been integrating with the world system progressively. So, trade GDP ratio, FI investment, FDI investment, some degree of these are the indicator which provide some kind of information about the integration of Indian economy or the progressive integration of Indian economy with the world financial system. If you see the graph here, I have put the FI, FDI, trade GDP ratio 93 to 94, 2002, the first phase of reform. The reform phase there has been significant increase in FDI, the rate this indicates the FDI increased significantly. The significant increase from 2003 to 2009, 2008. After that, there has been recession in world economy and there is significant decline after that. If you see otherwise 2003 to 2009-12, there is significant improvement in FDI, FI and also fluctuation is there in FI investment because of the world recession phase. and however, trade GDP ratio significantly increased over the year, and trade GDP ratio somewhat nearly 40, more than 40%, 40% to GDP. So, this is a clear path that world Indian economy in on the verge of high integration with the world financial system. If you see otherwise, if you analyze the stock market side, stock market's price return, I have taken into account the BSE return and the Nasdaq return, and the 93 same two phases of financial sector reform. One phase is called from 93 to 2002 is the phase of reform measure, and second phase 2003 to 2012 is a consolidation phase of reform. These two phases have different scenario for us. If you see the BSE return is fluctuating over the year, same thing also Nasdaq return, and at the same time BSE return here and BSE return, Nasdaq return is here. These two indicate that whenever there is a movements of Nasdaq, there are also a movement of the Indian equity market, because FIs are there in both market, and both investors are same. If you compare in FI side, so FIs are pulling the Indian stock market, and similarly FIs are also pulling the Indian the Nasdaq market. Two markets are almost moving in the same tandem, same way. This indicates that stock market in India some extent of moving with the world financial system, that is the Nasdaq stock exchange as the representative of the world stock market. So, I have these two markets are moving, the returns of the two markets are moving in the same tandem, which indicates that Indian equity market some extent integrated with the Nasdaq market or the world financial market. If you see the movement of Fed fund rate and call money rate, the Fed fund rate and call money rate also moving in the same manner. I have compared the reform measure, that is 93 to 2002, and the consolidation phases 2003 to 2012, both are there with you. We can see that the both markets are moving in tandem. The Fed fund rate and call money rate are moving in together, which indicates that there is some degree of integration of short term interest rate in India, with that is the Indian side is the call money rate, and the abroad side is the Fed fund rate of US. The two short term interest rates are moving in together, which indicates that some degree of integration is there. You see the graph 93 to 2012, I have taken the call money movement and the Fed fund movement, both are moving together, almost together, and indicate that some degree of relationship is there between Fed fund rate and the call money rate. The relationship indicate the integration of two markets, integration of these two markets, the short term markets of US and short term markets of India, the two markets are moving together, which indicates some degree of integration. If you go to the, if you observe the movement of forward premium and call money rate, the forward premium, as I mentioned earlier to you, is the when somebody convert the domestic currency into abroad currency or abroad currency into domestic currency, try to take the arbitrage opportunity, the arbitrage opportunity will be reduced because of the forward premium. And the forward premium indicate that the fluctuation side of the exchange rate. If the forward premium and short term money market rates are moving together, then you can say the two markets are integrated. So, here I have taken 10 years reform measure, 10 years each period, and try to find out call money rate and forward premium, 3-month forward premium, and try to see whether the two markets are moving together, two rates are moving together. If two rates are moving together, then the markets are integrated. If you see the graph, the call money rate, and forward premium, 3-month forward premium are moving almost similar phases, because these two markets provide opportunity for arbitrage. If the two markets move together, there is no opportunity for arbitrage. If there is no opportunity for arbitrage, markets are integrated. So, law of one price prevail here. Since the two markets moving together, there is no opportunity for arbitrage. If there is opportunity, suppose rupee, Indian INR and dollar, the discrepancies are there, then somebody will dollar interest rate and Indian interest rate two different differences are there, then somebody might purchase take loan from the US market in the form of dollar and convert the dollar into Indian rupee, take the advantage of high interest rate in India, and this is arbitrage opportunity. This arbitrage opportunity will not be there with a forward premium equivalent to interest rate differential. Since interest rate differentials and forward premiums are same, there is no arbitrage opportunity. So, arbitrage opportunity will be very less, that less part is only because of the transaction cost. Here the arbitrage opportunity possibilities are there if the call rate and the forward premium deviation is very large beyond the transaction cost, there will be arbitrage opportunity. So, we have put the graph of forward premium and call money rate, and this forward premium call money rate discrepancy over the years reducing, and this indicates that progressive nature of financial sector integration. So, similarly, if you see the correlation matrix, the call money rate and Fed fund rate, whether they are highly correlated, or the correlation indicate the together movement, the co-movement. The co-movements are very high, whether positive or negative, the co-movements are very high. Over the period, the co-movement is increased. If you see the first 10 years of reform, the call rate and Fed fund rate, the correlation was minus 0.32, very less. However, next consolidation phase of reform, that is 2003 to 2012, the co-movement has increased significantly, that is correlation is very high. So, they are moving together in a stringent way, or moving together indicate that there is a integration of two markets. Similarly, if you see the call rate and forward premium, the forward premium call rate, these two together also moving almost same pattern. Similarly, if you see the BSE, Nasdaq return and the Indian Bombay Stock Exchange return, the return is also moving almost very high correlations are there, and the correlation increased significantly later part of the reform measure. So, this is also indicate the Indian market is moving as per the world market, and the progressive nature of integration is there. But if you compare, these are some indicative part of the integration. We have discussed here the integrating part of the integration is that the co-movement of what is called high trade GDP ratio, the co-movement of call rate and Fed fund rate, co-movement of NSE and Nasdaq, BSE and Nasdaq, co-movement of forward premium and call rate, the correlation of all these parameters, the high correlation indicate the movements are taking place in a similar way. So, movements are co-movements are there very high amount, this indicates that the integration is taking place in Indian countries also. Though, however, if you analyze the economic theory, the interest rate parity hypothesis, which we have discussed earlier session, that interest rate parity hypothesis provide the ideal measure for the integration of financial market. There are two different kind of interest rate parity, as I mentioned earlier discussion, that interest rate parity hypothesis, covered interest parity and uncovered interest parity. Covered interest parity reveals us that, or postulate that, the spot interest rate differential between two different currency should equal to the forward premium. If the interest rate differential is equivalent to the forward premium, there cannot be arbitrage opportunity. However, if you compare the Indian interest rate and US interest rate, if you see the covered interest parity of two countries, here US interest rate, Indian interest rate I put minus the US interest rate I put high, this is equal to forward premium, this equivalent to the forward premium. So, Indian interest rate, suppose at present short term interest rate is going around 6% and minus US interest rate at present going around, short term interest rate is going around 2%. This is there is a difference of 4%. The 4% difference is supposed to be equivalent to forward premium, then there may not be any kind of arbitrage opportunity and two markets are integrated. But here you have to look at the forward premium and the interest rate differential. This interest rate differential should equal to the forward premium. This is nothing but what is called covered interest parity hypothesis. covered interest CIP, covered interest parity hypothesis, covered interest parity hypothesis. But question is here, why these two will move together? If there is no movement, what will happen? If the two are not moving together and the differential not equivalent to the forward premium, then what will happen to the domestic arbitrage opportunity? Here the Indian investor will borrow from US dollar and at the rate of 2% and convert into Indian rupee INR and get at the interest rate at the rate of 6%, and this 6% and repay after 1 year, convert the Indian rupee again to US dollar and repay the loan to the US company. So, here they will get the arbitrage opportunity of 4%. The arbitrage opportunity will not be available after, suppose after 1 year rupee depreciate by 4%. That is, today the forward premium equivalent to 4%, there will be no arbitrage opportunity available to us. So, this covered interest parity hypothesis mentioned here, the interest rate differential should equal to the forward premium. If these two happen, the market will integrated. Similarly, uncovered interest parity, if to understand the uncovered interest parity, the uncovered interest parity is mentioning us the interest rate differential, that is Indian interest rate minus the US interest rate should equal to the depreciation or appreciation of rupee as per the nature, depreciation or appreciation of rupee. So, what does it mean? If US interest rate, this example, same example, 6% minus 2% is equal to 4%, the rupee will depreciate by 4%, then there will not be any arbitrage opportunity. Similarly, the depreciation appreciation should be reflected by the interest rate differential. In case of UIP in uncovered interest rate parity hypothesis, the depreciation or appreciation should be equal to the interest rate differential. In case of CIP hypothesis, covered interest parity hypothesis, depreciation appreciation should be equal to the interest rate differential should equal to the forward premium. These two have to understand, and these two provide a indirect way of assessing financial integration. When there is financial integration, we have to understand this financial integration leads to financial integration or international financial integration. International financial integration leads to covered interest parity, that is interest rate differential in India minus interest rate in US should equal to the forward premium. In case of UIP hypothesis, uncovered interest hypothesis, the interest rate differential in India and in US equal to the rupee change, depreciation of appreciation of expected change in the exchange rate, expected change in exchange rate, expected change in exchange rate. This should be there. Then there is what is called financial sector integration is there. However, otherwise the domestic market is integrated with the world financial market. But whether it is possible in case of India, we have to understand that. What I have done here, I have taken the covered interest parity and uncovered interest parity. What I have done here, last 10 years, 20 years data I have taken, last 20 years data starting from 1993 to 2012 data. Here I have taken call money rate minus the Fed fund rate for, and I mention here what is called interest rate differential and interest rate differential. These two rate differential I have taken over the 93 to 2012 annual data and converted into a difference. I have taken interest rate differential. Then I have taken what is called the forward premium, annualized forward premium. I have taken forward premium annualized, forward premium annualized I have taken, and try to find these two rates are moving together, that is CIP hypothesis, interest rate differential equal to forward premium. CIP hypothesis I want to test. So, I have taken the call money rate minus the Fed fund rate and try to the differential I have taken as in the form of interest rate difference, and the forward premium annualized I have taken from 93 to 2012. The graph you can see here, the graph here the green is looking at the forward premium is the green, and the blue is the interest rate differential. Here I have taken the percentage here, difference in interest rate percentage, the interest rate differential. Here I have taken the year, y axis is the interest rate differential, x axis is the year, and blue is looking giving us the blue graph is interest rate differential, green graph is the forward premium. If you see initial year it was very high differential, after 93, 98, 91 this graph is moving very high. However, in case of 2006, 7, 4, 6, 7, 8, these are 6, 7, 8 is a period of what is called recession or the world financial crisis period. So, domestic economy was controlled so as to not allow any kind of negative aspect of the financial integration to the domestic part. So, it is this part we cannot compare. However, after 2008 these two are moving together. So, it may happen that after 2012 if I take 13, 14 graph, then we will find the two parts will be moving together. However, these two cannot be equal. Why? There may be some transaction cost also involved. The transaction cost you have to reduce. So, transaction cost may not, the arbitrage opportunity may be there, because the arbitrage opportunity is there, the transaction cost also there. So, you have to remove the transaction cost, you will see that these two graphs also moving together. Similarly, I have taken the uncovered interest parity. In case of uncovered interest parity, what I have done? I have taken the call money rate minus Fed fund rate. I put as interest rate differential. This is nothing but interest rate differential, and I have taken the annualized INR and US dollar rate depreciation change, that is percentage change, and try to find this interest rate differential and the movement of exchange rate change, what is the relations? Because this is UIP hypothesis telling us uncovered interest parity, interest rate differential should be equivalent to the expected change in exchange rate, spot rate. So, I have taken annualized data, annualized call money rate, annualized Fed fund rate differential, and say rupee dollar exchange rate percentage change every year, and try to find percentage change is telling us the spot exchange expected change in exchange rate. Try to find that whether UIP hypothesis is revealing something to us about financial integration. If these two are almost same, then you can say integration is there. These two, if you see uncovered interest parity, see the graph here, see the graph is the uncovered interest parity, also the blue INR spot change is the light red color graph, and the interest rate change differential is the blue color graph. If you see these two also moving together, the two are moving together, this indicates some degree of integration is there. However, these two are not together, not moving together only, they cannot be equal together. Why? Because interest rate parity hypothesis can only be equal if risk perception is almost 0 in two markets. the political uncertainty is zero almost to market. There should be complete capital account convertibility between India and between US dollar and India, US dollar and Indian rupee. So, capital account convertibility cannot be complete, risk perception cannot should be there and different will be there. This may be because of this reason these two cannot equal, but these two can move together. Moving together or co-movement indicate some degree of integration. This also indicates some degree of integrations are there. The integration is moving in a systematic way. So, what do you understand so far? The extent of integration. If you analyze all whatever the variable we have considered or the indicators we have considered, we can observe that some degree of integration is there between two countries. So, here the FI extent of integration, if you analyze for Indian context, the FI and FDI investments in India are rising. This indicates some degree of Indian markets are integrating with the world financial system. Trade GDP ratio has been increasing significantly, nearly 45% trade GDP ratio over the since 1994. This indicates that Indian financial markets or trade flows are there, or Indian financial market integrated with the world financial system. Stock market returns are moving in tandem, Nasdaq and BSE are moving together. This indicates that some degree of integration is there. There are a high correlation between call money rate and Fed fund rate. This indicates also some co-movement of short term interest rate. There is high correlation between stock return. This indicates co-movement of returns in the stock market. CIP hypothesis, though they are not observed in case of India. However, the discrepancy has been reduced over the year. This indicates that interest rate parity hypothesis is moving in progressing in a rapid manner, which indicates some degree of integration of Indian financial market. So, what are the drawbacks of these are the some kind of integration or indicators of integration, and Indian we have observed that Indian financial market moving at the rapidly toward the path of integration, but integration provides some kind of challenges. The challenges are huge in nature. The first challenges is that when markets are integrated, we get the benefit, at the same time we also share the risks. The risks of volatility has increased Indian market. If you have seen rupee, there are what is called high volatility Indian stock market. After 1994, we have seen very high volatility Indian stock market because of the integration path. The FIs are pulling money whenever they want to invest in other market. So, this pulling out of from the domestic market, there is high volatility in the stock market. We have seen speculative attack on Indian currency, that is INR. Indian currency depreciated significantly over the year, the speculative attack because of the integration path. Integration leads to risks. The world financial market risks has also come to the India, and one Indian market also now exposed to financial sector risks of world market. These are the challenges Indian, and at the same time RBI is not in a position, Indian central bank is not in a position to control the market because of the high path of integration. Whenever they take a step to reduce the inflation, to reduce domestic speculation of Indian currency, reduce the volatility in the market, they have to expose to the world financial system. The world exposed to world financial system has provided some degree of challenges on the part of the domestic monetary authority to control the world domestic economy for the benefit of the domestic market. So, when our markets are integrated with the world financial system, the domestic monetary policy very difficult to manage and very difficult to control the world financial system. And these are the some challenges we have to accept, because integration with the world financial system is the order of the day, and we have to accept the integration. We have to integrate with the world financial system. At the same time, we have to also take care through different policy measures to safeguard the domestic economy from the speculative attacks of world financial risks. These are the challenges, and the references are there. Here you can see the go through the references: International Finance by Thomas O'Brien, International Financial Management by P.G. Apte. You can go through the book and see the some kind of integration of some kind of discussion on the integration of domestic economy. And here model question I have designed for you. The model questions here: while defining international financial integration, describe various indicators of financial integration. So, we have to define what is financial integration and what are the indicators available to assess the integration. You have to defining, while defining financial integration, you have defined that the law of one price nothing but reveal the financial integration. When financial integration is there, there will be one price prevail in the market. So, that is the and one the investor will not get any arbitrage opportunity, that is called financial integration. The indicators of financial integration, as I mentioned earlier, the indicators are very difficult to measure the financial integration. However, there are some indicators are there which provide some degree of clue to observe the integration process. Then the indicators are as we discuss a trade GDP ratio, FI FDI investment, that we have discussed about interest rate parity, we have discussed about short term movements of interest rate, the high correlation of short term interest rate, then there are some indicators of integration we can discuss in this question. In the second question I mentioned here, in the Indian context describe the movements of various indicators of international financial integration. As we have discussed last 20 years different indicators like FI investment, FDI investment, trade GDP ratio, call money movement along with the Fed fund rate, call money movement along with forward premium. Then also we have discussed Indian context the CIP hypothesis, uncovered interest hypothesis. We have also discussed the returns differential in stock market of an NSE, BSE and Nasdaq. You can discuss about NSE and NYSE. We can discuss about London exchange rate and Indian exchange rate. We can also discuss about other indicators of integration of financial flow to GDP. This is also part of the indicator process. This is in using the data from RBI website, you can discuss other indicators of integration like the financial flow, like current account deficit to GDP. These are the other indicators of other indicators of financial sector reform. Okay, thank you.